Hello, because of the novel coronavirus pandemic, the Institute of Certified Public Accountants of Uganda postponed the June 2020 exams. The Institute has not yet announced the dates for these June 2020 exams, but the examination dates will depend on the guidance issued by the government in the due course. Now, students out there are relaxing. Some of them stopped revising back in March. Some of them are trying to revise, but the morale is low. Now, if your plan was to sit for exams in the June 2020, that is the first examination deity, then my advice to you is that you should continue preparing for these exams. The best preparation for tomorrow is always doing your best today. Me, I don't believe in luck, but I believe in preparations. Make sure you practice, make sure you revise, go through your notes. Where you're stuck, please contact your tutors. They will help you. If you need tutor support, subscribe to my YouTube channel, and I believe you'll get the support either by a phone call or by email, and all your questions can be answered. Now I have a revision phase package for students. I have prepared examination kits essential for exam preparations, and these kits are packed with the exam standard questions for you to practice. So I believe you need to get one of these revision kits because we know that they are exam focused and student friendly. Students have used them in the past and the feedback we are getting is a positive one. These kits can help you to pass your exams. Now today, let us try to go through IS10, that is events after the reporting period. This is a syllabus area for CPA paper 13, that's advanced financial reporting, and the SCCA, that is financial reporting. Let's go straight to IS10 and we see the content of the standard and what you need to know under IAS 10. Welcome in this session of CPA Advanced Financial Reporting Revision. Today we are going to look at IS10 events after the reporting period. Now in today's session we are going to cover some of the key definitions under IS10. We are going to look at the accounting treatment. We are going to look at the concept of dividends as well as the going concern assumption. We are going to cover the disclosures under IAS 10. Thereafter, we are going to look at the coronavirus pandemic impact on the financial statements. Then I'll take you through a practical application of the issues under IAS 10 events after the reporting period. This is Senior Hannington to take you through IAS 10 revision events after the reporting period. Now, this session is relevant to students of paper 13 CPA and students of SCCA financial reporting. What are events after the reporting period? Now, events after the reporting period are those events both favorable and unfavorable that occur between the year end and the date on which the financial statements are authorized for issue. So there is always that time lag between the year end and the date on which the financial statements are authorized for issue. So any event that occurs between those two dates, those are referred to as events after the reporting period, and they are accounted for under IS 10, as we are going to see. Now, IS 10 identifies two types of events. We have what we call adjusting events as well as non-adjusting events. So you need to know what are adjusting events and what are non-adjusting events. Now, adjusting events are those events that provide further evidence of the conditions that existed at the year end. Those are the adjusting events. Then non-adjusting events are simply those that are indicative of conditions that arose after the year end. So meaning that Here we have two statements which we have to look at. For adjusting events, the evidence of conditions exists at the year end. Then for non-adjusting events, those events that are indicative of conditions that arose subsequent to the year end. In other words, we are looking at those events whose evidence is for conditions that existed after the year end. Those are the non-adjusting events. So you need to know what events after the reporting period are, what are the two types of events, that is adjusting and non-adjusting events. Then from there you need to go ahead and master the accounting treatment of both adjusting and non-adjusting events. What is the accounting treatment? Now for adjusting events, we always need to adjust assets and liabilities where events after the end of the reporting period provide further evidence of the conditions existing at the end of the reporting period. So meaning that if it is an adjusting event, you have to adjust your financial statements, that is adjusting either assets or liabilities, if the event confirms the conditions that existed at the reporting period. Then for non-adjusting events, we don't need to adjust the financial statements, but we instead disclose important events after the end of the reporting period that do not affect conditions of assets or liabilities at the year-end date. So meaning that for non-adjusting events, there is no need of adjusting your financial statements. What you have to do is to disclose these events, that is if they are material. Now the concept of dividends. IAS 10 makes it very clear that dividends declared after the reporting period, those are non-adjusting events. So never recognize or never adjust your financial statements for the dividends declared after the reporting period. Never recognize them as liabilities, but instead we don't recognize them in the financial statements because they are non-adjusting events. Okay, those are the dividends declared after the reporting date or dividends proposed. The going concern assumption. Remember, financial statements should always be prepared on the basis of the going concern. That is, to assume that the entity is going to be in operation for the foreseeable future with no intention of liquidating. Now, what happens if the entity is to cease operations in the next period? Now, there is no preparing financial statements on ongoing basis if management determines that after the reporting date, either it intends to liquidate or cease trading. If that is the case, then we cannot prepare financial statements on the going concern assumption, but instead we have to use any other basis, talk about the breakup basis. So take point of that. Disclosures. What are the disclosures to be made when it comes to IAS 10? Now, for IAS 10, we make the following disclosures for the non-adjusting events. You always have to disclose the nature of the event. Then you should also disclose the estimate of the financial effect. If the financial effect cannot be estimated, then you should always make a statement that this estimate cannot be made. Then we can also disclose the date of authorization of issue of the financial statements and by whom. Then if the entities, owners, or any other personnel has the power to amend the financial statements after issue, then this fact should also be disclosed. Practical application. On 31st December, year 1, Entity G is involved in a court case. It is being sued by a supplier. On 15th April year 2, the court decided that Entity G should pay the supplier shillings 45,000 in settlement of the dispute. The financial statements for Entity G for the year ended 31st December year 1 were authorized on issue on 17th May year 2. So we see there is an event the company is engaged in. The company is involved in a court case on 31st December year 1. It is being sued by a supplier, but on 15th April year 2, the court decided, that is after the reporting period, because the reporting period is on 31st December, but on 15th April, we say that there is that event. The court is deciding that the entity should pay the supplier shillings 45,000 in settlement of the dispute. When are the financial statements authorized for issue? They are authorized for issue on 17th May year 2. So this is an event after the reporting period. So IAS 10 is applicable in this case. Now, is it a non-adjusting event or it is an adjusting event? But remember, by the reporting date, we see that the entity is already involved in a court case. So meaning that on 15th April year 2, when the court decided that entity should pay the supplier shillings 45,000 settlement of the dispute, that is already a confirmation of the conditions that existed at the reporting date. By the reporting date, there was already something. The company is involved in a court case. After the reporting period, by the time the court decides, it means that you have to adjust your financial statements. So that was, or that is an adjusting event. Let me take you through my suggested answer and we see. The settlement of the court case is an adjusting event, as I have told you. It is an event that occurred between the end of the reporting period and the date the financial statements were authorized for issue. It provides evidence of a condition that existed at the end of the reporting period. In this scenario, we see that the court provides evidence that the entity already has an obligation to the supplier at the end of the reporting period. So since it's an adjusting event after the reporting period, the financial statements of year 1 must be adjusted to include a provision of shillings 45,000. The alteration to the financial statements should be made before they are approved and authorized for issue. We have a practice question here for you. You can try it out and maybe you send your answer either in the comment section or my WhatsApp group on my Facebook account. I'll give you a feedback on your solution. 3 weeks after the year end, the internal auditors discover a fraud. The finance director has stolen shillings 30 million from a bank account, shillings 10 million before the year end, and shillings 20 million after. The theft is, of course, unreflected in the draft financial statements. Required: discuss the effects of the fraud upon the current financial statements. You can try out that and maybe you send your solution in the comment section, or you can inbox me in my channels. Then I'll give you the feedback and we see. Coronavirus pandemic and IAS 10. Now, I believe that the current pandemic is a non-adjusting event because most of the businesses are affected by the measures taken by the government to stop the spread and not by the virus itself. The measures taken by the governments happened mostly after the end of 2019. So meaning that they are events after the reporting period. But there is something to remember, that if the impact of the measures on your business resulting is so severe that your business will not survive, then the going concern no longer applies, and you should not prepare the financial statements under the going concern assumption. So take point of that. Now, don't forget to subscribe to my channel and share this video with your friends and colleagues if you think that they can benefit from it. And please stay healthy and safe. All the best to you. Senior Huntington. Thanks for